Hello, friends. Today we are going to learn about some of the best indicators in Forex trading. Forex trading relies heavily on technical analysis, which involves using a variety of indicators and tools to assess market conditions and make trading decisions. These indicators help traders interpret price action, identify trends, and determine optimal entry and exit points. Among the most widely used indicators are moving averages, Bollinger bands, the relative strength index, RSI, trend lines, the moving average convergence divergence, MACD, support and resistance levels, the volume weighted average price, VWAP, and Fibonacci retracements. Each indicator serves a unique purpose, and understanding them deeply is critical for effective trading. Moving averages are a cornerstone of technical analysis as they smooth out price fluctuations to highlight the underlying trend. There are two primary types: the simple moving average, SMA, and the exponential moving average, EMA. While the SMA provides an unweighted average of closing prices over a specific period, the EMA assigns greater weight to more recent data, making it more responsive to current price changes. Moving averages are often used to identify trend direction and crossover strategies, such as when a shorter moving average crosses above a longer one, signal potential buy opportunities. Conversely, a downward crossover may indicate a sell signal. Traders often combine moving averages with other indicators for confirmation. Bollinger bands, created by John Bollinger, are a volatility-based indicator that consists of three lines: a middle SMA and two outer bands plotted at standard deviations above and below the SMA. These bands expand and contract based on market volatility. When prices touch or move outside the bands, it may indicate overbought or oversold conditions, signaling potential reversals or continuation patterns. Bollinger bands are especially useful for range-bound markets, where traders look for mean reversion opportunities. The RSI is a momentum oscillator that measures the speed and change of price movements on a scale of 0 to 100. It helps traders identify overbought, above 70, or oversold, below 30 conditions, signaling potential market reversals. RSI divergence, where the indicator moves in the opposite direction of price, can also provide early warnings of trend shifts. As a leading indicator, the RSI works best when combined with other tools to avoid false signals. Trend lines are simple yet powerful tools for identifying and confirming trends. By connecting significant highs or lows, traders can visualize the direction of the market and potential areas of support or resistance. When prices break a trend line, it often signals a potential reversal or acceleration of the trend, depending on the context. MACD is a versatile indicator that combines elements of trend and momentum analysis. It consists of the MACD line, signal line, and histogram. The MACD line represents the difference between two EMAs, while the signal line is an EMA of the MACD line. Crossovers between these lines often indicate buy or sell signals. The histogram visualizes the difference between the MACD and signal lines, providing insights into the strength of momentum. Support and resistance levels are price areas where the market has historically reversed or stalled. These levels are pivotal for determining potential entry and exit points. Support acts as a price floor, while resistance serves as a ceiling. When these levels are broken, they often switch roles, with broken resistance becoming support and vice versa. Identifying these levels requires a keen eye for historical price patterns and volume activity. VWAP is a hybrid indicator combining price and volume data to calculate the average price a security has traded at throughout the day. It is particularly popular among institutional traders and day traders as a benchmark for assessing fair value. When prices are above VWAP, it suggests bullish sentiment, while prices below VWAP indicate bearish sentiment. Traders often use VWAP to determine intraday support and resistance levels. Fibonacci retracements leverage mathematical ratios derived from the Fibonacci sequence to identify potential reversal or continuation zones. Common retracement levels include 38.2%, 50%, and 61.8%. Traders plot these levels between significant highs and lows, using them to anticipate areas where price may stall or reverse. Fibonacci levels are especially useful in trending markets, where they often align with other technical indicators. A holistic approach to Forex trading involves integrating these indicators and tools rather than relying on any single one. While each has its strengths, they also have limitations, such as susceptibility to lag or false signals. Successful traders combine them to validate setups, manage risk, and adapt to varying market conditions. For example, using moving averages for trend identification, RSI for momentum, and Fibonacci levels for precise entry points can create a robust trading strategy. Additionally, staying mindful of market fundamentals and geopolitical factors adds an extra layer of context to technical analysis, ensuring more informed decision-making. Make sure you like this video and subscribe the channel before you go. Thanks for watching.